Tesla cars to retain tax credit under revised IRA rules in U.S. Tesla vehicles will retain the EV tax credit under revised IRA rules. Model Y and Model 3, except for the RWD version, will receive the maximum credit amount. The new rules come into effect on April 18. The U.S. Department of the Treasury has announced it is revising its tax credit rules for electric vehicles EV under the Inflation Reduction Act IRA. They are more stringent and will reduce or eliminate exemptions for many electric vehicle models that previously received them. The new rules will come into effect by April 18, 2023. Days before the end of March, Tesla notified consumers that they had better buy and take delivery of its vehicles before the end of March, as the revised rules could go into effect starting April 1. With the publication of the rules on Saturday, some details have been clarified and the company has updated the information on the website. As expected, Tesla Model 3 rear-wheel drive RWD will no longer be eligible for the full $7,500 tax credit. However, consumers who have been eyeing the car have time until April 18 to complete their purchase and accept delivery and receive a $7,500 credit. It is worth noting that other vehicles, Model 3 and Model Y, are eligible for the federal tax credit. Tesla notified consumers. On January 1, 2023, the Inflation Reduction Act of 2022 qualified certain electric vehicles EVs for a tax credit of up to $7,500. Based on new IRS guidance, the $7,500 credit is now anticipated to be reduced for Model 3 rear-wheel drive on April 18. Qualifications include: customers must buy it for their own use, not for resale. Use the vehicle primarily in the U.S. Adjusted Gross Income (AGI) limitations. MSRP price caps. Under the new rules, to be eligible for the full $7,500 tax credit, electric vehicles must meet two sets of criteria. If a vehicle meets only one of these two requirements, it is eligible for a halved tax credit of $3,750. The first set of criteria requires at least 50% of the cost of battery components to be produced or manufactured in North America in FY 2023. The minimum percentage of the cost will increase annually to stimulate the development of the industry. The second set of criteria requires that at least 40% of the value of critical minerals used in a car be extracted, processed, and/or recycled domestically or in a country with which the U.S. has a free trade agreement. The minerals include cobalt, copper, nickel, graphite, and lithium. Source: reposted and summarized from Eva Fox at Tasmanian. My take: this tax credit is part of why Tesla is going to have a great year.